Most people believe economies thrive because of innovation, productivity, and the hard work of millions. But what if the engine powering modern prosperity isn't growth at all, but an ever-expanding spiral of debt that governments promote, financial institutions depend on, and citizens unknowingly shoulder? What if the real mystery is not how countries succeed, but how they avoid collapsing under the weight of obligations that can never truly be repaid? To understand this hidden structure, we must start by recognizing a disturbing contradiction. The world appears wealthier than ever, yet nearly every major nation sinks deeper into debt each year. Buildings rise, markets soar, and consumer spending surges, yet behind the glitter lies a system that demands constant borrowing just to maintain the illusion of economic health. This system didn't emerge overnight. Its origins lie hundreds of years in the past, when early societies relied on gold, silver, and tangible assets to settle debts. Money had inherent value, and borrowing was constrained by what people physically possessed. The rules were simple, rigid, and transparent, leaving little room for manipulation. But as nations expanded and governments sought more power, military strength, and infrastructure, the old system became too limiting. Kings and rulers wanted resources they didn't have, and they needed a way to finance wars, trade routes, and industrial ambitions. Enter government debt backed not by wealth, but by promises. The Dutch Republic in the 1600s was the first to issue large-scale government bonds, effectively selling the future to pay for the present. England quickly followed, using debt to fund wars and empire building. What began as a temporary solution soon became a permanent strategy: borrow now, worrying later. Then came the creation of central banks, starting with the Bank of England in 1694. These institutions allowed governments to borrow continuously, unlocking an entirely new economic model. Instead of saving for expenditures, nations could spend first and worrying about repayment decades or even generations later. This was the beginning of the debt spiral. Debt was no longer a burden. It became a weapon, a resource, and even a form of currency. Bonds could be traded, pledged, or refinanced. The requirement to repay became less important than the ability to service interest, creating a system where perpetual debt was not a failure, but the goal. Fast forward to the Industrial Revolution, and the demand for credit exploded. Factories, railroads, canals, and shipping networks required massive capital. Banks responded by lending more than they held, a system known as fractional reserve banking. Money was no longer tied to anything physical, it was created through debt itself. This meant every loan was effectively new money entering the economy. And with every repayment, a portion of the borrower's effort and future was transferred to the lender. Ordinary people didn't realize it then, but the system was quietly shifting wealth upward while expanding the power of banks and governments. By the 20th century, the world was fully dependent on debt to function. Wars, reconstruction, industrial growth, and national development all relied on borrowing. Yet the biggest turning point came in 1971, when the United States abandoned the gold standard. For the first time in modern history, major currencies were backed by nothing but trust. This moment transformed the financial landscape. Governments could print more money, borrow without constraint, and manipulate interest rates to control economic cycles. Debt became the foundation of modern finance, not a temporary obligation, but the core mechanism driving everything from consumer spending to corporate investment. But with this newfound flexibility came new vulnerabilities. As nations borrowed more, markets grew accustomed to constant intervention from central banks. Economic downturns were no longer natural corrections. They required stimulus packages, bailouts, and liquidity injections, all financed by more debt. This pattern became painfully clear in the 1980s during the Latin American debt crisis. Countries borrowed heavily in foreign currencies, only to face skyrocketing interest rates and falling exports. Instead of forgiving the debt, global institutions imposed strict conditions, austerity measures, and restructuring programs. The spiral tightened, and everyday citizens paid the price. A similar story unfolded in Asia in 1997. Over-leveraged economies collapsed under speculative capital flows. Currencies crashed, foreign investors fled, and millions lost jobs. Once again, the solution involved more borrowing, more intervention, and more dependency on external institutions. The 2008 financial crisis showed just how deeply indebted the world had become. Mortgage-backed securities and complex derivatives created trillions in artificial wealth. When housing prices fell, the illusion evaporated. Banks teetered on collapse, but were rescued with government bailouts funded by, you guessed it, more debt. Instead of restructuring the system, policymakers doubled down on it. Central banks slashed interest rates to near zero, injected trillions into financial markets, and pledged unlimited support to keep economies afloat. The debt spiral accelerated, and global markets became addicted to cheap money. Today, global debt exceeds $320 trillion, more than 3 times the world's total economic output. The United States alone has surpassed $35 trillion in national debt, while consumers and corporations add trillions more each year. No nation has a real plan to repay these sums. The world is living on borrowed time and borrowed money. But here's the twist: the system doesn't require repayment. In fact, repayment would collapse everything. Debt must grow endlessly for the economy to function, because new loans create new money. Without constant borrowing, nations would face deflation, unemployment, and economic contraction. This means governments are trapped. Raising interest rates causes recessions. Lowering them fuels bubbles. Cutting spending slows growth. Increasing spending requires borrowing. Every path leads back to the same spiral. Meanwhile, citizens bear the hidden costs. Inflation reduces purchasing power, meaning your salary buys less each year. Housing prices soar because cheap credit fuels demand. Taxes rise to pay interest on national debt. And job insecurity increases as companies prioritize profits over stability. Corporations exploit the system as well. Instead of investing in innovation, many borrow cheaply to buy back their own shares, inflating stock prices and executive bonuses while leaving workers behind. Debt becomes a tool of inequality, concentrating wealth at the top. Yet consumers are drawn deeper into the spiral too. Student loans, mortgages, credit cards, and auto loans create the modern lifestyle but also trap millions in decades of repayment. The system encourages spending money you haven't earned to stimulate growth that doesn't benefit you. Even when governments attempt to break the cycle, the system resists. Austerity measures reduce debt temporarily but cause unemployment and political instability. Raising interest rates fights inflation but crushes borrowers. Printing more money fuels asset bubbles and long-term instability. The reality is unavoidable. Every solution relies on more debt. Every crisis creates more intervention. Every intervention reinforces the spiral. And every year, citizens lose more ground while the economy grows increasingly fragile. The debt spiral doesn't just power economies, it defines them. It shapes government policy, financial markets, consumer behavior, and even social expectations. Growth becomes synonymous with borrowing, and prosperity becomes a temporary illusion sustained by credit. But the consequences are becoming harder to ignore. Housing is unaffordable for younger generations. Inflation outpaces wages. Savings erode faster than people can accumulate them. Retirement becomes uncertain. And financial crises occur more frequently, each one more severe than the last. So what can we learn from this? First, debt is not a temporary condition but a permanent structure of modern economies. Understanding how it works is the first step to protecting yourself from its consequences. Second, crises are not anomalies, they are features of the system. They reset markets, justify new policies, and accelerate dependence on borrowing. Recognizing the cyclical nature of these events helps you anticipate what comes next. Third, citizens must navigate this environment with awareness and caution. Building financial resilience, diversifying income, investing wisely, and reducing personal debt can provide a buffer against fluctuations you cannot control. As the debt spiral tightens around nations and individuals alike, the real question becomes, how long can a system built on perpetual borrowing survive? And more importantly, what can you do before the next crisis arrives? If you want to understand the forces shaping your financial future, subscribe, share this video, and stay informed because the debt spiral isn't slowing down, and neither should your awareness.